Well, I'm really excited for our next guest speaker session to host Omer Cedar from Omega Point. Omer is a co-founder and CEO at Omega Point. Before Omega Point, he was a senior vice president of research at Two Sigma. And Omer is really someone I've come to respect and learn from as a thought leader in this space, particularly his work on the Omega Point Insights area of the business, where Omega Point releases white papers and interesting webinars in the world of factors and factor risk management, and the Getting Sharp podcast. One of the most topical concepts in the factor investing world now is the influence of factors. From a pure academic view, quantitative researchers don't really view themes as factors. Again, factors should be robust across markets, persistent over time, and themes tend to come and go, work in some markets, work at sometimes, not work at others. Now, if you're sitting in the seat when a big thematic piece of news is released, you realize that that's purely an academic view. From a practitioner view, we clearly understand that themes are increasingly explanatory of risk and reward in markets, and a systematic view of understanding thematic exposures in your portfolio, in my opinion, is an incredibly important part of prudent risk management. To dig deeper into that concept today, I'm very excited to have Omer from Omega Point to talk about identifying, quantifying, and managing themes. Thanks so much, Omer.
Thank you so much, Brett, and thank you everyone for listening to me today postulate about themes. The thing that seems to be, like Brett said, from a quantitative perspective or for quants, sort of a secondary topic. But for those of you who are sitting in seats and on the day of DeepSeek, it didn't feel very secondary, right? In the way that the markets behave. So themes are real. Themes are important. We believe they are real and important at Omega Point, and we think that you should be incorporating them into your investment process. So let's dive in and talk a little bit about themes. So ultimately, if we sort of have a quick history lesson, and I'm sure some of you have already are aware of this and are familiar. This is, naturally the world of factors kind of got going right around the early 50s, and probably really Bill Sharp in the early 60s with the CAPM model was the first one to really popularize it. But ultimately, today we have so many factors out there, so many models built for quants, and really the world of fundamental PMs, and thinking about how to actually manage a fundamental portfolio using factors was not really taken into account back then as much. Ultimately, fundamental investors think a lot in themes, right? So this is really from that perspective, is how to take a fundamental first approach when you're translating factor risk analytics to fundamental investors. Really where Omega Point began is really bridging the fundamental and the quantitative disciplines. So saying, okay, well, you have a fundamental manager over here who's doing bottoms up analysis on companies. You have a quant manager over here who's thinking nothing but factors all day long, signals and factors. There's a factor aware manager that's kind of sits somewhere in between that really tries to incorporate what the quant manager does and what the fundamental manager, and we wanted to intersect those two in an easy to use way for people to have, but also create a community that talks about this regularly. And that's ultimately how we've evolved. And now really, as we think about this, factors were the initial piece of that, but now it's factors and themes, right? Again, portfolio managers think in themes. They think in fundamental thesis. They think about what's the market dynamic, what are the industry drivers. They're thinking about, new innovations that are coming into the market that don't have any historical data behind them, right? It might be a new theme that's taking shape around, obviously, AI, intelligent farming. There's new, dynamics happening in the macro space, right? Obviously, we're seeing that happening with the new administration in place. So there's a lot of these things happening really on the left that even company-specific thesis that could be built up in such a way that it's a mini theme or something that is impacting, let's say, a group of 20 or 30 companies, maybe not 3,000. But ultimately, those are important, right? On the other side of it, right, the quants are speaking in factors and systematic risk. They're looking at things that are going to be impacting 3,000 companies at any given time. And they want to make sure it's very robust to a very long-term trend. And that's good. That's why factor models have been very robust and have allowed for a framework for risk management for so many years, because it does actually allow you to look very, very much historically over a long period of time and know that these types of factors do have an impact, on a varied impact scale, but they have an impact to do that. Um, so investment teams today, as we're thinking about this intersection of factors and themes and fundamental and quant managers, they're saying, okay, so I understand that factors are there for the long term. I understand the themes might be more transient. So can you help me understand when a theme is emerging, when it's peaking, when it's fading? And then, okay, fine, that's my understanding of the theme, but how am I going to actually quantify a stock's exposure to this theme, right? So, it may not be I may not be directly have, an exposure or some kind of a characteristic that I can identify with it. So can you help me understand how I can understand to derive what the exposure and the risks are coming from this theme? And then finally, how do I actually manage my portfolio to all of this, right? I have this factor model, and now you're telling me that I need to include a bunch of themes into it. This feels very messy. How do I actually make it work? So those are the kind of questions we get regularly. And those are the types of things that are very important when you're thinking about how to integrate factors and themes. Now, again, themes ultimately think about it as a data bridge. They're not necessarily this independent thing, but they actually are helping you understand what's happening in sort of fundamental investing land and what's happening in sort of factor land, quant factor land, because themes aren't independent of factors. They could actually overlap with factors, right? So you can have factors, that have a particular subset of characteristics, value, growth, momentum. You've probably learned a whole host of different factor models. Um, but the idea is that these themes might actually have some overlapping associated with them, and they are a superset. In fact, they could be, integrated or put into these factors or looked at separately from those factors. But there's definitely a lot of overlap between themes and factors. And so as we kind of talk about this, continue to think about the fact that this is not an independent world of factors. They're very much live in the same world as factors, and there's definitely some overlap in between them. Okay, so definition of factors and themes. We talked a little bit about the fact that factors are broad, persistent characteristics of securities that help explain risk and return, right? So, they're structured, they've been around for a while, we know they work again and again and again. And in some ways, they're actually very rigid. And that's a good thing, because if they weren't very rigid, then they may not be that robust, right? If they're too flexible, then all of a sudden a definition change of a factor between 2005 and 2015 and then 2025, oh my God, like what am I actually looking at anymore? So having a rigid definition of a factor across time allows you to make sure that you're actually looking at it the same way in the past as you're looking at it now. While the market might still change and the factor may not explain as much in the future because of this sort of rigid notion, that's okay. You're able to get that consistent notion of what the factor is at any given point in time. A theme can actually morph itself, right? It doesn't have to be the same characteristic that it was 10 years ago and today. In fact, the theme may have not even existed 10 years ago, right? Obviously, AI, Bitcoin, cloud computing, right? Clean energy, all of these things are examples of theme, and they can be very messy and difficult to quantify, right? But ultimately, that is actually changing, and this is the area that we're going to talk about today. So before we jump into some of the methodology and the details, just wanted to highlight, you know, the idea is that this is the same workflows that you're already potentially learning and doing on factors. This is not something totally new that you're going to say, oh God, now I have to learn this completely new framework that is out of left field, and I'm not going to be able to really integrate it. So just to be clear, this is a framework that is very well known. It's very similar to how factor models are built today. We're just applying that to a new set of categories and characteristics called themes. Okay, so let's jump into some of the groundwork. First of all, we want to start with something that helps identify or answer that first question about identifying when a theme is actually emerging, when it's peaking, when it's fading, right? And in order to figure that out, we're actually created a metric we call TSI. TSI actually stands for thematic strength indicator. Okay. So essentially what it is, it's an actual measurement of how strong the theme is in the market. Now let's try to, unpack that and understand how that's actually calculated, and we'll go into some of these details. But the general idea is that let's start with the notion of what a fundamental risk model is. I think that you've by now probably learned about what fundamental risk models are, how they're built. Again, they're predetermined with their choice of risk factors, right? They're very transparent. They're not dynamic. We talked about that. They're very rigid factors, but they're also robust. And you know what you got 10 years ago, you're going to get today from a value definition perspective. Momentum is going to be the same as it was 10 years ago because the definitions are the same and because the method of computing everything is the same, right? That's a fundamental risk model, and they're very popular and they're very used. However, there's also the notion of statistical risk models, right? And some of you may have learned about statistical risk models, but those are actually very dynamic and they're not very transparent. However, what they can do is that they can come up with a lot of interesting new correlations, really, and covariance structures that the fundamental risk model might not be capturing. Where the fundamental risk model is transparent, the statistical risk model is very intransparent, right? You don't know what these factors are, right? They usually are derived through something like a PCA, right? Principal component analysis. And so ultimately, in some way, what we're trying to do here with themes and this thematic strength indicator as a starting point is to say, why don't we actually combine these two things? Why don't we take the fundamental risk model and the stat model and combine it in a way that we can take the risk factors that we know today about and along with the themes, and let's identify if there's some additional variance that these factors are not capturing, right? In the fundamental risk model, but maybe through the statistical risk model, we're picking up all this new variance. We just don't know what it is. It's some X factor. But by being able to map it back to some of these thematic risk factors, okay, we're able to now capture them. Okay, so TSI is ultimately, as a starting point, it's a measurement that helps you connect, right, the variance that's in the marketplace today to a theme. How much of that variance in the marketplace is actually coming from that theme? Okay. So if we break that down, let's start with a total return, right, in the market of any given number of securities, right? Let's take the Russell 3000. You have a universe of stocks, and each of them every day has a total return, right? In fact, they have a time series of returns, right, across time. And what you're doing is you're saying, well, let's think about something here where we have a market component. We know the market is a big driver, right? That's essentially CAPM or very close to that. The market is a big driver of the initial component that is moving the return. So let's remove that and let's ask ourselves, like, there's a additional return we are going to call the residual return. Now, we know from factor model perspective, residual return or idiosyncratic is also X factors. But at this point in time, we're not saying we want to do that yet. What we want to do is we want to take the market component out, and we want to take this residual return and we want to be able to take it and split it up into two components, which is the thematic influence. Okay, that's where the themes are, and the exogenous factors that are really coming from the risk model. So ultimately, what we're saying is the combination of the known risk model factors and the thematic influence is going to help us isolate what this indicator tells us. So the thematic strength indicators, essentially, it relates, okay, a themes, movements, and returns with the security universe's returns, okay, and existing factors that we already are aware of, but it uses something called an asymptotic IPCA framework, instrumented PCA. We're going to have some materials for you around that that share that you can read more into instrumented PCA. Won't go into the details of the math behind it, but the general idea is that that is the framework that's being used here to be able to combine both a statistical approach and a fundamental approach. And then there's obviously some robustness around how you have to do that. But the intuition that we're trying to sort of come out with here, the total intuition is to say that the thematic influence that's coming from a particular theme or a set of themes, right, is orthogonal or different from a set of exogenous factors that we already can explain, right, and the market, okay, and the output of that is something called the thematic strength indicator. Okay. Since this is pre-recorded, I'm sure you're gonna have a lot of questions, and you can always put them in, and we'll have follow-on sessions to discuss this. But starting with TSI is really the backbone of what we're trying to target here. As we continue to move forward and think about how to integrate themes into factors, right? We have basically what we just talked about, the TSI, and we refer to it as the systematic risk that is coming from this theme. This is how much the theme is explaining movements in the market. It's just like in some ways, it's sort of the factor R squared, right? Um, but we also know that we have something called a thematic beta, and the thematic beta is ultimately the exposure of every stock in that same universe to the theme. So what is its exposure? The exposure can be measured in various different ways, but most often in this type of an environment, because remember, the theme is not a price to book. It could be your exposure to AI, to tariffs, to, energy independence, all sorts of things. You have to basically derive that exposure using a time series regression. Okay, so that's ultimately what we're talking about, how to derive a thematic beta. Obviously, for those of you that know time series regressions, there's many ways to do that. And there's various robustness techniques and how you make sure that you are deriving a beta that is not spurious. But understanding that those are various techniques that you apply on that, the core concept here is that there's a thematic beta that is being derived that helps you understand, again, what the underlying securities exposure is. And when you tie both the thematic beta and the systematic risk, you can then explain residual alpha. And we kind of call this the thematic risk triangle. So it's the idea that, you know, you might be looking at your portfolio and there may be a lot of ideo or alpha, and that's great. And you're really happy about that. But you're also noticing that when the portfolio might be moving around, there's a lot of movements that appear to be shifting all the stocks at the same time, not a single stock, but all the stocks, and they're all considered to be ideo. So how is it possible that ideo, as we know from the perspective of a factor model, is supposed to be uncorrelated, that is actually driving all these stocks? Well, that usually means that there's maybe an embedded theme in that idiosyncratic risk or in that residual alpha. Okay. And that's where understanding what the betas are of stocks to various themes, understanding the systematic risk of the theme are the components that help you then explain the actual ideo or what the risks are that may be unexplained by the risk model in any given time. Okay. Um, Again, the goal here is that we have a systematic framework to identify these sort of thematic portfolio exposures that have high systematic risk. We don't really care about, there's so many themes in the market. You don't want to go after a theme that is explaining, less than 0.5% of what the movements in the market. That's not going to really help you. Sure, you could have exposure to it, but if it's not really explaining much of what's going on in the market, it's probably not a very important theme to be included. So with that kind of groundwork, we talked about thematic beta, we talked about TSI, and we talked about sort of the residual alpha, and this thematic risk triangle will come up again and again. We want to start looking at how you can actually see something like this in action, because that's ultimately what we want to do. How do we implement this into our portfolio, and how do we actually use it? So the first step is, and this is kind of a recent a study that we looked at, is let's take a look at which themes using TSI are actually moving in the market right now. So what's interesting is, as of today, which is essentially, we're in the beginning of March, so this is sort of March 5th. We can look at it in two different ways, which themes are moving the market, and it really depends on your view of what is important, right? We had gone back in our prior a diagram, and I'll actually refer back to this because I think it is important. We said there's a market component and there's a residual component. And we can take that residual component, we can assign it to some exogenous factors from a factor model, and then the thematic influence is the remaining amount. But some people might say, you know what? I don't want to take this residual return and assign it to these exogenous factors. What if I just wanted my thematic influence to be just included with the market component? So let's knock out these exogenous factors. The first piece here that you see here, these are essentially the themes when you're looking at, either ETFs or various baskets or other types of frameworks, that when all you're doing is when you're moving the market, these ones have the highest explanatory power in the market today. What is interesting here, right? When you're taking a look at this particularly the US market, when you're taking a look at this, I hope you're seeing that you're noticing things like small cap, value, mid cap, sector information. That doesn't seem very, sort of, I would say, exotic theme oriented. And there's AI obviously here. So that is maybe more exotic. What you see here is these are just general factors, right? This is a style factor, style factor, style factor, and a sector factor. Well, wait a second. If we use market adjusted returns and we don't go, and again, going back to this sort of notion, we don't take out these other exogenous factors that are coming from the model, you will find that a lot of the themes that you're defining through different methods that explain market returns, non-market returns, are actually factors in a factor model. Surprise, surprise. So ultimately, the idea being that market adjusted returns is a good way to start for a lot of people who aren't familiar with factor models. It might be actually a good way to describe to a portfolio manager who is not a factor aware portfolio manager to say, listen, right now, if you just exclude the market, these are the most important themes or factors that are influencing the returns. So you should be focused on cap, which is size. You should be focused on some sectors. You should be focused on, value growth. And, obviously it's interesting that AI is definitely popping in there. But many of you are working with portfolio managers and working in a context where you're already comfortable with the fact that there's a factor model explaining a portion of the returns. So you're not really interested in re-explaining those returns. You're interested in explaining the returns after all the factors using those themes. And that's where you basically remove these exogenous factors. And so you're removing market, sector, and style returns. And you're computing the TSIs just using really this final piece here, that is thematic influence when the exogenous factors are removed. Given that piece, what's important here is that now we're really seeing that there are themes here that, yes, some of these are sector or subsector oriented, but they're definitely some exogenous or exotic, I guess, oriented themes. You see things like quantum computing, you see high short interest, you see data and infrastructure. 10-year treasury short is actually an interesting theme that's impacting the market. So these are real themes at the moment that are not necessarily being fully explained by the traditional factors, right? And this is really where the fun begins, I would say, because what you've just done is you've taken a list of, let's say, 500 themes, and using the thematic strength indicator, you've basically narrowed it to 10. And you said, what are the 10 most important themes I should care about right now that I should integrate potentially in my factor model? And that is potentially these 10, right? Now, obviously, depending on your investment universe, right? This is US market. You might say, but I care about global. I care about Asia. I care about the tech. I'm a financials manager. The good news is that TSI is not just purely for the market. It can be built off of any investment universe. Okay. So that's an important component. And that might be different themes are going to be driving the investment universes. The other thing to also notice is that this is the themes that are moving in the market right now. Were these themes important in the past? Well, let's take a look at some examples. For instance, this is jets, and this is a theme that basically was, represented airlines. It was very, very, very low explanatory power in the period leading up to COVID, and you can see that it had massive explanatory power in the COVID period, and then came back down, and certainly has been up and down since. But ultimately, it's a theme that was sort of emerging, right? It peaked in the COVID period, and then it really has faded since, right? Having TSI across time helps you get the context for, is this theme important today? And has this theme been important in the past as well, right? So gives you a relative sense of what's important today and what's been important in the past. So you can also make a decision whether to include that theme into your analysis today or for your own back testing needs. This is ICLN. So this is a theme obviously representing clean energy. You can see that basically that one had peaked a little bit more in the 2022 period. It fell back down in 2023, and it's actually been rising quite a bit in the 2024 period as well. Social networks, an interesting one that, definitely had peaked in 2021, right? In the height of that and has really faded and has come, out of style. So what would you do here? I mean, ultimately, are you going to treat this theme or consider this theme important? Well, it really depends on what period of time you're managing um, the portfolio through and what you're trying to test. Right at the moment, you might not consider this theme to be important, but social networks was important. So if you're trying to do any kind of testing, stress testing, or work back in the 2021 period, 2020 period, you might consider that theme as an important one. So before we jump into the next section, one of the things I just wanted to highlight is that themes so far we're looking at is what's important today, and then we're looking at it in the past. But we can also take a look and think about what is the future impact coming from a particular set of themes. And this is where the idea of stress testing or scenario analysis comes into play. So in many cases in factor models, right, we're using a factor model to explain past returns or past movements in a portfolio, but we're also using it to explain what ex ante risk or what the future may hold, right? And so ultimately, the idea of themes is that it's very similar. We can take that information and we can look ahead and make a suggestion as to what do we think is going to happen, based on an election outcome, right? If this is obviously in the past now, and when we did this analysis with our investors a couple of months ago during the US election, we were able to understand based on the Republican and Democrat themes out there and their exposures across multiple other themes. So we almost intersected them and said, hey, you know what? Cyclicals and defensives, right, seem to have a much higher um, exposure to Democrats versus Republicans. We can see things like innovation and versus actually unprofitable tech actually had a higher exposure, interestingly enough, on the Republican side. You can see investor position was actually negative on Democrat and positive, slightly positive on Republican. By doing that, you can say, well, if the election outcome is X, here's how we expect companies exposed to these themes to react, right? So we expect that there's going to be potentially a positive move in the onshore, in the in any theme. If Republicans, obviously, which they want, we're going to see a theme difference where if anytime you see a negative number here, right, it shows that the Republican policy is going to drive success in that underlying theme. And so what we're going to look at is anything that has a negative here for Republicans. That's going to be the driver of how the companies are going to behave that expose that theme based on that policy. And anytime we see anything positive, we're going to look and say, this is actually how we expect in a Democrat win companies to behave. And so you can see sort of the material differences between the two really suggest different outcomes. Okay. So broadly speaking, what are we doing here? We're taking thematic exposures that we computed and we're saying, while we understand that their TSIs may be high or low, why don't we actually look at them and project them against different outcomes and policies? And then that helps us understand what might happen in the future in an election outcome. So that is a scenario analysis, and that's to look at broadly in the market what might happen. Ultimately, where we're trying to bring this into is a portfolio, right? We would like to use themes on a portfolio. That is ultimately the final kind of a piece here that kind of brings everything together, the TSI, the thematic betas, and whatnot. And we're going to use an example where, one of the portfolios that we're running in Omega Point, we saw some very interesting negative alpha returns. And they weren't simply 5 names were driving this. It looked very systematic. There were a lot of companies that were seeing significant alpha drag, right, in the crowded longs and crowded shorts portfolio that we had. And we want to understand what was going on there. So, right, so again, we're talking about the thematic risk triangle. We can see that we have residual alpha, right? And this residual alpha appears to be negative, and we're, obviously trying to, if we're in this market, we're trying to generate some positive alpha. So our goal is to understand what's driving that negative alpha and how can we maybe take action on it. So we also had done some analysis at the same time and gone through a bunch of thematic, baskets in the healthcare space. We actually pulled up one of the Morgan Stanley healthcare baskets, and we were like, that's interesting. The Morgan Stanley healthcare basket is also seeing a negative drag over a similar period. And, we ran the TSIs on it and it was strong. So we're like, this is interesting. Is this a coincidence? Well, Let's test it out. So what we did is we literally took all of the thematic baskets, along with their TSIs. So you can kind of think about a two-dimensional graphic here, right? You have on one axis, you have the TSIs, and then the other axis, you have the thematic betas. The thematic betas are for every individual stock. Remember, they're beta to the theme. And what you're trying to identify in in the portfolio is, where am I going to find high TSI themes where I also have high thematic betas? Okay. And so this kind of section here, this sort of box that we're sort of highlighting and shading, are the actual themes, right, within this sort of group of themes that we care about, that have both high thematic betas and have high TSIs. And so we want to kind of get into the details of that, how that plays out further. And what we really want to do is, again, we want to explain the residual performance of this US healthcare crowded proxy portfolio. So we're going to take these themes that we had high TSIs on and high thematic betas, and we're essentially running a regression. It's very simple. We're running a regression to include them as part of our attribution analysis and understand whether they explain any of the performance. And what was interesting is that we actually found in this case that everything from AI, anti-obesity, and even some specific factors within healthcare. So now this is volatility in healthcare, momentum in healthcare, which, remember, in factor models, these could be built across cross-sectional, right? So they could be across an entire global universe. It could be entire US universe. Sometimes when you actually look at them at the sector level, you're going to find that volatility, momentum, some of the standard factors are actually explaining some of the residual movements. Okay. So we found that those plus like things like anti-obesity, GLP-1s, and so on and so forth, and AI adopters were all important themes that were actually explaining a very meaningful portion of this alpha. Okay, so that is a practical use case. You can actually identify the themes. You identify the thematic betas of the themes, right? So you have your systematic risk from TSI, thematic betas in the stocks, and then you basically are explaining residual alpha in this method. What's important is that there's a lot of good reading material that you can look at, and we are certainly excited to be able to, walk you through this in more detail. But, spend some time on the Omega Point website. We've spent time going through various forms of different approaches for how to look at themes, how to look at the thematic strength indicator, how to look at thematic betas, and certainly familiarize yourself with it. We're excited to go to the next step and talk about the case study that we've put together for you to be able to actually put this into action.
And Omer, maybe we'll take questions now before we talk about the case study. I had a few that came up. Wanted to just go back into, you talked about going from 500 themes down to 10 themes. What does that process look like from the broad theme identification? We talked about the Morgan Stanley baskets. Like, what is a systematic way to think about that kind of new theme identification? I'm not sure I fully followed that part.
Sure. Think about it from the perspective of, you have a database of thematic, what I'm going to call proxy, either portfolios, baskets, any kind of really factors that people build, but any kind of a type of a uh, structure that can be measured, that you can measure a return on, I guess, is the best way to think about that. Okay, so you have a library of even assets, right? The idea being that every single one of them could be a theme. You don't know if it's a theme yet, but it could be a theme. Okay, so that library is pretty sizable and large. It could be 500, it could be 1,000, it could be even bigger, right? Omega Point has, between a lot of interesting exotic factors around macro, crowding, right? People measure crowding in different ways. All of these things can be built into essentially, you can think about factors or proxy portfolios that you can measure the return on any given day. Okay, so now you have a return space, right, across all of these different factors or themes, and you measure something called thematic strength indicator, the TSI. Now you measure it per theme, right? You measure the thematic strength indicator across a common universe of securities. Remember, we talked about this idea that, hey, you could be a global manager, you could be a Asia Pac manager, you could be a US manager. You want to do it on the universe that you care about. Otherwise, it may not make sense, right? Globally, obviously some themes are going to matter, but other ones are not going to really pop out. So if you really want to do it in a good way, you want to do it across a universe of names where you know that's going to be your investable universe. That universe of names, what you're really doing is using this thematic strength indicator framework. You're measuring how important each and every one of those themes in this 500 to 1,000 name theme is in that universe on any given day, right? And then your goal is to understand, obviously across time, which ones are most important for the period that you care about to do the analysis. Because again, you're not going to be trying to add 1,500 themes to your underlying risk model. That is way too many. What you're trying to do is identify 15 to 20 max, usually, that you feel very confident are explaining some movements in the marketplace, not being necessarily explained by the risk model that you want to add as an augmentation.
How do you find clients typically using this? Like, to what degree are clients identifying, oh, this is an accidental thematic exposure, I want to hedge this out? Or are they using this more in with an offensive intentional lens of, yes, I see this TSI picking up, which means that I can explain returns with this theme. That gives me a green light to make a more thematic bet within my portfolio.
Yeah. It's a great question. I think the first step is awareness, right? Before we even take an offensive approach, let's even be aware of what themes we're exposed to. And again, what themes we're exposed to in a way that isn't necessarily stretching us to have to look across 1,500 themes and say, well, we're picking up residual exposure here and we're picking up residual exposure there. Intersect that with, again, TSI and identify the themes that are most important right now over some period of time. And within those, which ones do we have thematic exposure to? Those are the ones that are going to be most relevant to our portfolio. Okay. So ultimately, those are the things that, we're gonna start tracking and managing, right? Now, the question about how we take action, and I think you kind of went into this sort of like a defensive posture and offensive posture, really has to do with, are these themes we have a view on or not? Right? Just like in the factor space, in the factor model, you're looking and saying like, do we have a view on these factors? Do we really think we know anything about them? Many style factors, investors are going to say, I have no view on that. But if we go to the sector factor land, a lot of times people talk about ideo plus sector, right? As being a component that you want to add together. You want to say, oh, I want to actually add the sector return in because I believe that I have the ability and some skill in shifting or aligning more with sector selection. So if you believe in that, you might include that theme and you want to be offensive on it in this case. If you have no view on the theme and you're like, oh no, I've got an exposure to rates right now. I don't really have a macro view right now on rates. I don't want anything around it. Well, then take a defensive exposure, right? And just try work on hedging out that theme.
And in a classic risk decomposition, so say I'm allocated 50 million of vol, and that turns into $1 billion of gross capital. How can you take this TSI concept and actually think about like a value at risk exposure? Or can I look at my portfolio and say, hey, if AI power has a -3 standard deviation move, this is my P&L exposure? Presumably would be kind of an interesting quantification of thematic exposure to a portfolio.
Absolutely. I mean, one of the things we do regularly and will be part of this case study is the ability to be able to understand your thematic exposure in this type of a framework. So what happens if there's a one standard deviation move in the theme? How's that going to impact my portfolio? Well, that is a sensitivity that you just talked about. What's my basis risk, right? In the portfolio, given a one standard deviation move is a very, very common question that gets asked, not just by themes, but also we know by factors, right? If momentum moves one standard deviation, what's going to happen to my portfolio? What if it moves three standard deviations? Like we've seen momentum move, right? So same thing with a theme. You can use that exact same framework. By the way, you can also do it as an idios. You can look at the exposure X factor. So you can say, how much of my ideo is this impacting, right? Which is also interesting from that perspective. So if you have your ideo VAR and you're saying, wow, look, my ideo VAR is 4 or 5%. I'm really excited about that. But it turns out this one theme is 100 basis points of ideo VAR, then you should be aware that it's not pure fundamental uncorrelated ideo, that there may be some thematic factors lurking in there.
I love this framework because in so many dimensions, investing has become more of a scientific approach, scientific risk decomposition. But the thematic part of investing still seems to be very, very not unscientific. What have you learned? Are there any lessons you've learned about, what constitutes a good investable theme or the momentum of themes? Like, are there any frameworks around investing in themes that are common takeaways from this work you've done?
Well, I guess I would like to say that, mathematically, themes can be very, you can use a very scientific framework, right? TSI, betas, and whatnot. These are very scientific approaches to be able to measure, right, a movement to a factor, just like you would, if you try to build a macroeconomic risk model, right? Stocks don't necessarily have exposure to GDP. You have to think about, given a movement in GDP, what's going to happen to the company. So it's very much a similar process where you're trying to derive something based on a kind of a robust correlation versus an actual sort of physical exposure in the stock. So there is definitely some, there's a systematic and a framework around it. But to your point, you don't have, though, a nicely laid out set of characteristics that you can kind of combine. And so the themes can get a little, like we said, get a little messy sometimes, right? You're looking at a theme and you're saying, wait a second. First of all, does this even represent what I'm even trying to look at? Especially like, how many different versions of AI can someone create, right? They can create AI, the power producers. They can create one around software adopters. They can create one around the hyperscalers. They can create all sorts of things. They can even mix all three in a theme. And so the question is, first step is this theme, you know, important and relevant in the market today or in my investable universe? TSI, irrespective of how the theme is defined, if people are trading on it and it's actually explaining the movements of return for a period of time, it's got to be something, especially if it's systematic, right? So the idea is, if you're measuring something that's systematic, irrespective of what you believe the definition of it should be or how it should be represented, it's important, right? Or that representation of it's important enough for you to care. So that's the first step. That's why we're saying identify the things that are actually important and winnow all the things that are just noise, right? The tree fell in the woods, nobody heard it. A lot of these themes are like that, right? They look really cool and they have a lot of interesting characteristics or companies and names behind them. But when you actually measure their TSIs, they don't explain anything. So then you're saying to yourself, okay, is it the theme that's not explaining something, or is it the representation of the theme that this person has created through an ETF or a basket or some factor that's not explaining very well? It might be more of an implementation problem than the actual theme itself. That is where the art comes in, because ultimately, when you're going to go to the fundamental PM and they believe in that theme, they're banging the table and they're saying, guys, this is a real theme. It's actually happening on the table. You need to be aware that there is some qualitative characteristics out there that someone might say, I disagree with you. Even if your systematic tools tell me it doesn't really matter, I'm telling you it matters. You have to sort of go one more step further and do the analysis and try to identify what makes this theme actually either work or not work, right? And that is where like you said, that's where the art comes in, right? You could do all the systematic testing that you want, but at the end of the day, there are going to be some themes out there that somebody truly believes in, and you're going to have to do work to identify them, using more fundamental methods.
As far as I can understand it, you're looking at the statistical correlation of an individual stock with a theme to get the loading. Is there an ability to take a fundamental view and to say, "Hey, this is the earnings leverage to this theme," or is that too difficult to do across a cross-section of, large groups of stocks in this sort of approach?
Well, I think that there's sort of a couple of steps here. So think about the first point that you made is you measured a loading to a theme, which means that you know that there's some relationship that the stock has um, to the underlying theme. And ultimately, if you do this across many stocks, you're now able to have created essentially a factor proxy for the theme, right? So you have a theme, you have a bunch of stocks that you measure their loadings. Okay, now I have a factor or something that looks like a factor because it represents 2,000, 3,000 names. Some are going to have very small loadings, some are going to have larger loadings, but you're going to have a cross-sectional now distribution, right? You can apply characteristics on that factor now. You can say, well, let's analyze the factor using fundamental methods, like you said, leverage or valuation. Let's take a look at the top quartile of that theme, and let's look at the valuation of that versus the bottom quartile of the theme. Is the valuation stretched? You do the same thing with factors today, right? Top quartile versus bottom quartile analysis, or any kind of work around that to try to understand what is actually happening fundamentally with this theme. What is it actually representing? Is it a lot of semis? Does it have a lot of consumer retail? Is it totally, off base, and it's just, looking at being short rates, whatever it is, all these types of characteristics that you're testing, and it's actually part of what the analysis we're going to do for the case study, is to try to look at that theme through multiple lenses that you already know. That's going to give you an understanding of how this theme actually is interpreted in the marketplace, right? If you believe that the theme exists and these names are exposed to the theme, then understanding, I would say, fundamentals is important on it, right? Understanding kind of traditional sort of even cyclical or rate type of characteristics from a macro side is very important. And then thirdly, I would say just understanding the sector decomposition of that theme, right? What does the sector composition and distribution across the theme look like? Is it going long energy and short something else, and so on and so forth? Those are the things that will help you better understand it.
How important are flows in understanding themes? My prior is that, some of these thematic baskets may be more driven by retail, by ETFs, maybe by large macro players. Have you done any work on flows, and are there any signals we could think about monitoring to kind of understand either, maybe the TSI is picking up or fading, or flows or crowding? How might I think about those elements as I'm thinking about thematic orientation?
Yeah. Well, I mean, we know that there's definitely going to have to be some relationship between volume and price. It's not if you have a very high TSI, it means that it's explaining movements in the cross section, right? Meaning these returns are moving and this thing is moving alongside them. So it could be spurious, but if it's over a number of days and you're looking at it across months and you're saying, this volatility, the cross section of this volatility is actually being explained by this particular theme, you have a lot more confidence in it. Now, naturally, you can do a similar analysis through flows, right? Through volumes purely, and just say, forget about returns for the moment. Let's just try to understand if we're noticing that there's more flows into names highly, exposed to the theme, and flows in the names out of names that are less exposed to the theme or negatively exposed to the theme, right? So again, remember we talked about the idea you can measure valuation of a theme, you can measure macro characteristics of the themes, well, you can measure flow characteristics of the theme. And so you can say, what's the liquidity profile look like for a theme? Do we see a lot more coming in or a lot more going out? That should also give you an indicator of whether there's more trading or more activity in this theme.
Kind of just a high level illustratively without, specific clients. How are the different types of clients using this? I think generally there's a view at the multi-managers that they're really going long Coke, short Pepsi, long Pfizer, short Merck. In my experience, there's actually more room to express a thematic bet than most might understand. That's just one person's experience. What's your take on that? Like, between long only single manager family office and multi-manager clients, how do you see the kind of common differences in expressing a thematic bets within the portfolio?
Yeah, it's a great question, and one that can be thought of in two different ways. One is that um, there's maybe a hidden factor or transient factor that you're not aware of, and so everyone's kind of potentially maximizing to different ideo in the different books, but there's maybe a tilt. I remember seeing this in 2023. Remember when we were coming out of 2022, the downturn, people still believed, hey, rates are still high, rates are not coming down, you know, the economy is not doing very well. But remember, ChatGPT just came out. There's a big euphoria around AI, and everybody was already talking about how growth is going to come back, right? The economic growth was going to come back. And what you saw actually that was interesting was that there was a hidden negative GDP bet that was a theme in some of the multi-manager portfolios. So they were short economic growth. Why? Because, hey, I don't believe that this AI thing is going to just suddenly make everything take off. Maybe it'll make NVIDIA take off and a couple of other names and yay. But come on, are we really talking about the entire economy improving just because of this? So there was sort of this skepticism that was expressed, and it was not being captured fully by models. You actually were finding that that was being captured more on the ideo space. And so that was a theme that was bubbling up, right? So that's one thing. But the other thing that could be happening, and this is more recently, imagine that you have all these mini bets across multiple themes, but the themes are correlated. So you have a covariance across the themes, but you have all these correlations that are positive and you have small bets. So nobody's actually taking a big bet in the theme, an individual theme, but collectively they're all becoming correlated. Just like if you're taking on a bet in momentum and value, and those happen to be correlated today, and they were negatively correlated last week, or let's say 3 months ago, all of a sudden you'll see more factor risk in your portfolio. So you can see more thematic risk by taking small bets with more correlation versus the first situation where you were taking one sizable bet, just was unaware of what that bet looked like.
Last question I had on thematics. I hear this a lot, and maybe more as a complaint than anything, that the market is more thematic than it ever has been. And maybe that's just we live in the age of AI and Ozempic and some really dominant themes. Is there any way to observe that with your approach and kind of understand market wide how much of vol has been driven thematically on a longer term lens? One, do you think that's true? Two, do you think there's any way to kind of scientifically validate or invalidate that fundamental investor complaint?
No, we've actually done that. I wish I would put the slide on it. We'll have to find the slide and add it to the case study. There's actually a very simple measurement. The TSI, look at at the median, the 75th and the 95th percentile. Let's say you have a list of 1,000 themes, right? And you're measuring the distribution of the TSIs across time. So you're measuring the different percentiles. Well, in a thematic market, you would expect that the median, the 75th, the 95th would all be moving up in TSI. In fact, if we simply, just for the purposes of this, look back at the underlying themes that we were thinking about, and I'll just sort of go back for a minute just so that it's easy to sort of see what we're talking about here. There's a couple of themes that I went through when I went to the into the deck, right? And ultimately, we go back to this slide right here. Yeah, some of this slide is a great slide. During COVID, I think everybody agrees that was a very thematic market, right? I mean, there weren't that many themes that were important. There's a couple big ones, but they were very, very important. This is what you see when you think about thematic markets. You see the average, what you're going to see is that the median TSI rises, the 75th, the 95th rises, and in less thematic markets, they fall. Now, this is again for one theme, jets, but this could just be the median, the 50th percentile theme in a given distribution of themes. You obviously need to have a large enough number of themes to measure it. If you only measure it across 10 themes, you might see some spurious movements. But 1,000 themes that are out there, you're going to see something like this. And that's actually what we saw during COVID. That COVID was a very thematic market because the median, maybe it wasn't 13% explanatory power in the universe, but it was somewhere around, I think, 7 or 8%, which is very, very high.
Wonderful. All right. Well, thank you so much for being with us, Omer.
Absolutely. No, it was a lot of fun.